Okay, so let me start. I'm Nancy Conrad, and I asked Bob Zachmeier to join me to put together a presentation so he could share some of his awesome ideas. I heard Bob speak probably, I don't know, it's been a year or more now that I was at one of the ASREA meetings in Phoenix. I live in Phoenix. Bob, you're in Tucson. And he had come up and he said some things that I made notes on that were illuminating. And I think at that time I was able to put one of those ideas to work right then and there, I think like the next month. So I've always been keeping an eye on you, Bob. And then when you had
That was December of 2015, by the way.
Was it really? Oh, it was a while ago. Okay. So then at that point, when you had made a presentation for Scott Carson and his We Close Notes group. I think you were doing something with his note camp, which I've gone to, and I would recommend for anybody learning about notes. And you made a presentation there, and you added some more information.
Right.
And you do that. You just keep adding more great ideas. So I'm going to give it to you, Bob, and let you take it away and talk about what you're working on.
All right. Well, thank you, Nancy. I appreciate the opportunity to share what I do with people. And yeah, I started in notes actually a long time ago. The first note I ever did was back in 2002. And I had a manufactured home park that I totally renovated. I had it sold 5 different times, and every single time it fell out for financing. And then I started thinking, when we bought it, the owners carried us. So what if we carried the new owners? And my there were 3 couples that owned it, 6 business partners. We went in and we took out 401k loans against our Raytheon 401k plans. And we went and paid off the note we had, and we carried the property. And I sold it immediately as soon as I carried. And then this is where I learned about how liquid notes are. I started getting a postcard every week from people wanting to buy that paper from me. So here was a property that I tried to sell for 2 years, and every time it fell out. But the minute I had it on paper, everybody wanted to buy the paper, but nobody wanted to buy the property. That was a wake-up call for me. So I've been doing this off and on for a long time. I got distracted with the REO business. During the recession, I sold 2,000 REO properties in 4 years. Best month ever as a real estate agent was June of 2011. I sold 62 properties in the month of June in 30 days. It was just crazy. And then in 2012, it just vaporized. All the inventory went away. What was left were a whole bunch of people that had been harmed by the recession that couldn't get financing. So I went back to my old playbook and said, hey, what about these notes? And what if we finance these people with financing when the banks won't give them a loan? And what I found was some of the most successful, hardest working people in the community who are self-employed business owners, those are the people that the banks have singled out not to lend to. It's just crazy. These people make far more than the average person, and they work harder. I don't know a single self-employed business owner that works a 40-hour a week. I mean, they're all more like 80 or 100 hours a week. Yeah. And those are the people that the banks won't lend to. So it just made total sense of this is what I'm going to go to next. So here's a little bit about me. I bought my first rental property back in 1982, and I worked at Raytheon, as I said earlier, for 22 years. Combination of Texas Instruments, and then our defense division was purchased by them. I quit in 2002, which is just shocking to me. 16 years ago, I walked in and hung up my badge, and I was done. And it took me 3.5 years to go from an idea on a bar napkin to the #1 selling agent in our MLS. And for 4 years, we just blew everybody away. We're the only team to ever sell more than 600 properties in a single year here in Tucson. And 4,000 homes in the last 15 years. So, and then during all the travel for the REO, I had a lot of downtime in hotel lobbies and airports, and I started writing books. And I'm actually am just publishing my 6th book. It's called Who Needs the Bank? And it's all about seller financing. And that actually is going to be a book that you're going to want to write down and keep, because it was actually intended for people who are meeting with those they would like to have be financiers to them. And it's a leave behind book just to answer all the questions about private financing. And the idea of the book is that you can read it cover to cover in less than 2 hours. Each chapter is 1.5 to 2 pages long, so very, very simple. You can find the chapter on the question you have, and in less than a minute or two have that question answered. So it's a really well-structured book, and I'll go over that a little bit later. I have a weekly radio show I've had for 6 years here in Tucson. It's on Sunday mornings at 10 o'clock, and I have a huge following from that show. And I mean, literally my phone rings every week, multiple times a week, from people just saying, hey, I want to sell my house. And who is this? It's a really good way to advertise, the best advertising dollars I've ever spent. And the thing that makes me kind of unique is every day I'm out there, I'm a lifelong learner. I'm constantly learning. I can learn as much from a guy pushing a mop as I can from the CEO of a company. And if you just open your ears, which God gave you 2 of, and shut your mouth, which you only have 1 of, you'll find a lot of problems out there. And if you can just figure out a way to solve them, you will be just unbelievably successful in this business. So I have a webinar every Tuesday. I have a national group. I coach people in 28 states on how to do notes. And we have a online portal. We have a buy-sell group for notes and creating notes. And every week we finance deals on that call. And basically anybody that calls me during the week to ask about structuring a deal, I'll help them structure that deal, but then I'm going to put it on the call on Tuesday so that everybody can learn from that deal. So everybody's interested in discounted notes, and the big question, where do I find them? And the answer is you don't find them, you create them. So notes that are at a discount, as Eddie Speed would say, they have hair on them. And basically there's problems with them. And, I bought several discounted notes, non-performing loans back in 2012. And it took almost 5 years to get off from under them. And they were horrible, horrible notes. But what it taught me was a really important lesson was don't buy other people's junk. And every one of these notes had been recycled. And we thought we were getting this great deal on them, purchasing them at 30 cents on the dollar. Now I can't believe people are paying 65, 70 cents on the dollar for a non-performing loan. When I show you what I'm doing, and I'm getting a way better deal than that on brand new performing loans that the people are hugging me and bringing me brownies to the closing, I mean, there's no way you want to go buy somebody else's junk. So this is a traditional example. Let's just say for even numbers, it's extremely hard, if impossible, to find a $100,000 home in Tucson anymore. But just for easy math, let's just say that the value of the property is $100,000. Now, whether you're a real estate agent or not, you can walk in and use this exact sheet and just say, look, your commission is probably going to be around $6,000. Your closing cost for the seller is going to be another $1,000. The buyer's more than likely going to ask you for their closing costs. That's $3,000. And then the home inspector comes and they're going to ask you usually about 2%. So in this case, $2,000. So if you got a full price MLS offer, you would net about $88,000. Your problem isn't selling your home. We have an extremely low supply market. Your problem is going to be finding another home to live in, because a buyer is going to come in, they're going to tell you how much they want to pay. They're going to give you a big list of all the stuff they want you to fix, and then they're going to tell you when they want you out. Now, this is a seller's market, so why would you let the buyers drive the bus? So my offer is very simple. What if I just write you a check for $90,000, and all you got to do is tell me what date to put at the top? When do you want to cash the check? If you want to do it next week, I got that. You want to do it next year? I got that too. You want any time in between? No problem. So now, instead of being forced into a 2-week window to go find a new home by some buyer that's you're under contract that you have to get out, you're either going to move twice or be homeless. This is a much better offer for you. It's going to net you more money, lets you move on your timeline with no hassles. Basically, you go to bed tonight, you're done. You don't have to make your bed in the morning. You don't have to have strangers in your house. You're just done. So most people that I meet with will take this deal hands down. So I always tell people I could jump out of an airplane with a parachute, land in a city I've never been in before, and have a home under contract for 90 cents on the dollar before sundown. So if, I don't buy ugly houses. I want pretty houses. Matter of fact, I want the prettiest house on the block. I don't, when you buy a home that needs work, what you're really buying is you're buying yourself a job. I don't want a job. I already have a job. I got plenty of jobs. So I want to buy something that people will walk in and say, wow, this is great. So I can, believe it or not, buy that home without any power tools at 90 cents on the dollar. That's way better than getting a home that needs 3 months worth of work and tens of thousands of dollars for 70 cents on the dollar. So if I can buy it at a discount, that means I can buy a $100,000 home for 90 that needs basically no repairs. So now I can solve buyers' problems. LMA.com is a mortgage software that most of the banks in the country use. They report that 27% of all the people that are applying for a loan, and this has been fluctuating between 25 and 30% every month, of the people that try to get a bank loan are turned away. So almost 1 out of 3, 1 out of 4 people is turned down by the bank. And many of these people are self-employed business owners. Well, I found that if I offer the financing on the home, it's just like having granite countertops. It's like having a home on the golf course. You can home sell in price ranges, and you can get the high end of the price if you offer something that other people don't have. So because I know that my money's going to be tied up for 30 years or potentially 7 years when they really probably are going to move, basically I know that it won't spend as far when I get it back. So I need to charge a little bit more than what its value is today. So if I look at my analysis, I made $10,000 on the buy, 15 on the sale. That means that's a $25,000 profit on a $100,000 home. So if I had my real estate hat on, I would make $3,000 on this sale. If I have my investor hat on, I make $25,000. Guess which number, Nancy, I like better?
Yeah, makes sense.
So here's the way I would structure that deal. This varies a little bit, but this is a very, very conservative approach. So I would say, okay, the buyer is going to put down at least $15,000. That's 15% of the true $100,000 30-day MLS value. I'm going to put on a first position note of 70 to 75,000. In this example, I used 70, and then a second position note for 30. So the first question is, why do I go for 2 notes instead of 1? And the answer is basically, if the 30-day value on the MLS was 100, I sold it for 115, the buyer put down 15,000, that means that you would have a $100,000 loan on a $100,000 home. That's not a very good investment. You're not protected at all. And when you're going for a retiree who has money sitting in the bank, their biggest issue is security. That's why it's sitting in the bank. They believe that the bank is secure, a safe place to keep their money. So any investment has risk, and you can't use the word safe, but this is a very, very secure investment because it's only a first position loan at $70,000. So now the second position loan, that doesn't get paid any principal or interest until the first has received all of the principal and all of the interest. So that second is a much riskier loan, but that is a loan that I would participate in because I want to keep that money lender secure. If I keep them secure, guess what happens? They tell all their friends. They come back. Every time they get paid back, I know because I'm the first phone call where they want to lend money to me again and again and again. I've got people who have been friends and real estate clients for close to 20 years. And these guys have been lending to me over and over and over, I mean, dozens of times over the last several years, just because of the way that I structure the notes, and I have their back. So we actually even had a deal that didn't close, and the money sat at title for 3 weeks, and then there was an heirship issue where one of the children who inherited the property wouldn't sell. They wouldn't sign the papers. So it ended up falling apart, and the investor had their money at title for 3 weeks, and we basically paid the interest and the wire fees to give them their money back, even though we never purchased that deal. If you treat your lenders like that, believe me, they know that you have their back. And man, when you need money, I mean, I literally, when I want to fund a deal, I can send out an email to less than 30 people, and usually I'll have a deal funded in under 5 minutes. It's pretty amazing.
It is amazing.
So it's pretty simple structure. That's where the 115 comes from. So now if the down payment's 15 and the first position note is 70, that one I will sell to a retiree. That's 85,000. If you recall, on that $100,000 property, the homeowner agreed to sell it at 90 if they didn't have to pay the real estate commission, the buyer's closing costs, and the excess repair costs. So basically what I need to buy that home is $5,000 of my own money. So that's a perfect investment for a Roth IRA.
Yeah,
Now,
I bet people do those all day long.
Exactly. So now the $30,000 note, remember I only need 90 to pay for that home. So basically I sell that to a Roth IRA for $5,000. And now that's a total of $90,000 to give to the homeowner. So I just purchased a $30,000 note for $5,000 bucks. So let's look and see what the terms are. $30,000 at 8% for a 360-month term is $220.13 a month. So first of all, if you put on your real estate hat, it would take me about 14 months to earn my commission. Instead of getting paid the 3% I was going to make, it would take me 14 months to earn my commission. And then every 14 months after that, I would earn it again and again and again and again for the next 30 years. So with the $5,000 that I'm paying, basically it takes 22 months to get back my $5,000. So since I bought the note for $5,000, my yield isn't 8, my yield is actually 52%.
Amazing.
And so you think about all the people that are buying non-performing loans, trying to make a profit. It's like, man, I'd rather risk $5,000, have people that love me, and make 52% on my money. So first question, is 52% a sustainable amount of interest? And I'll be the first to tell you it's not sustainable. It's going to be a lot higher than that. And the reason is because nobody's going to stay in their home for 30 years. So when they pay me back, they actually owe me 6 times more than I paid for the note. When they pay me back, they're going to give me a 600% return on principal, plus the 52% I've been getting on the interest. So that's pretty amazing.
It is amazing. Holy cow.
So, and several times more than I paid. So here's the bottom line. 22.7 months. I'm going to get my $5,000 back every month, all the way through. So these kind of deals are everywhere. And the bottom line is, this is the biggest thing you have to change in your mind. If you have an unlimited source of money, again, by treating your money partners fairly, you can do all of these deals. And we've all been trained to send our deals to, when we get a buyer, we send them to a lender to give them the loan. Well, why? There's a reason banks have the tallest buildings in every major city in the world. And it's because they're making all this money on interest. Yeah. So it's estimated there's $10 trillion sitting in idle cash in U.S. banks earning less than 2%, 0.2% interest. And 30% of all the IRA money invested in IRA companies in the United States is sitting in cash. So the money that's out there is a just unbelievable, huge chunk of money. Your job isn't, you don't try to sell money. You don't chase money. Money chases you. So basically what you have to do is educate people. And the best way to educate them is to show them what you're doing. So if you're not doing notes and you're trying to talk someone else into doing it, good luck with that. If you're doing notes and someone says, how does it work? I love to just take out my phone. I have a whole directory of pictures that is nothing but checks. And my bookkeeper sends me text messages every time she makes a deposit. And it just says deposit, deposit, deposit. And it works just like this. I just, I go away, and we're going to Greece here in a couple of weeks for a 2-week period. I know Scott Carson's over in Italy right now. And, we've been actually taking a couple trips to Europe a year. Next year on St. Patrick's Day, we're going to be watching the St. Patrick's Day parade in Dublin, Ireland.
That sounds great.
Yeah, we got some really cool trips planned. We're going to Croatia in September. We're going to Portugal, I guess, this November. So, I mean, it just, notes have enabled me to just take 2 months a year off for travel, world travel, and just go see the things that I've wanted to see my whole entire life. So, I've been a landlord since 1982. I like being a lien lord a lot better. So here's something, the first thing with notes is everybody wants the big money, the excessive 16% or better, yield on notes. I just showed you I get way, when somebody tells me they want 16, I just look at them and say, why so little? I make 52, on mine.
Yeah.
But if you're waiting around, and this is what happens, people get analysis paralysis. And once they hear about a 16% note, then they just sit there and they leave their money idle, doing nothing, waiting on that. So I always tell people, if you're waiting for a 16% note, there's probably some other things you're looking for too, including Bigfoot, Santa Claus, unicorns, and a pot of gold at the end of the rainbow. So, set expectations that you can meet. So if your average interest rate is 16, but you're only able to keep the money deployed for 3 months out of the year, guess what? You only make 3.9% on your money. So here's 2018. Let's see, January, February, March, April, May are already all gone. So basically you have 7 months of this year left. If your money has been sitting in the IRA doing nothing since January, you've already lost nearly a half of the year of interest. So even if you had a 12% return, for the first 5 months you made nothing. So now you're going to make 1% a month. So your 12% return ends up being 7. So all those deals that you pass by in 8 or 9 or 10%, you should have taken, because your money sat there doing nothing, and now you're going to earn 7 this year. And what's really important is when you look at a 30-year compounded interest on a 100,000 at 8%, if you just kept rolling the profit every year, and you lost, if during that time, during 30 years of time, you only lost 10% of the time that your money wasn't deployed, you would lose the last 3 years. Which look at the money you earned on $100,000 during the last 3 years. So basically, cost you $207,000 for not having your money deployed only 10% of the time over that 30-year period. And at 10%, it's $433,000, and at 12%, it's $863,000 on a $100,000 investment. So the biggest lesson learned here is consistency. Keep that money working. As soon as it's done, put it into something else. If one paid 15 and the next one only pays 12, take the 12. I mean, put it in, keep it working.
Yep.
So now let's talk about baby boomers. Every day in this country, baby boomers are 10,000 of them are turning 65 years old. So the baby boom goes from 1946 to 1964. So in 2011, the very first baby boomer started turning 65. We are in the 7th year of a 19-year run. So tomorrow it's 20,000, the next day it's 30,000, 40,000, 70,000 people a week, and 3.65 million people a year are turning 65. So when they get out, these are the investment choices they have. Well, I could be a landlord and have a rental home. I could put the money in a bank, or I could invest in the stock market, aptly described here with a roller coaster, right?
Yes.
So first of all, according to Landlord Station, 89% of Americans are non-investors. Only 3% of Americans are actively looking to buy rental properties. The other 8% are landlords by accident. Basically, they had a home they couldn't sell and they turned around and rented it. So traditional investors hold their property in rental properties, and they are mostly tired of tenants and toilets. And this is just a disgusting picture. But the thing is, it hits home. And this is a huge source in a very low supply market. Landlords that don't want to be landlords, if you educate them that they could make more money and never have another tenant in their life with notes, you would get a lot of property. This is where we get a lot of our properties from, is actually from landlords that don't want to be landlords anymore.
Oh, sorry.
So now, what if you put your money in the bank? Well, they pay a whopping 0.2% a year. So for every dollar, 10,000 invested, you get $1.67 a month. That's one Starbucks every 3 months. If there's 2 of you, that means one Starbucks every 6 months. So is that the best use of your $10,000? This is actually from one of my clients here in Tucson. They have their money in Vantage West Credit Union, $201,000, and last month they got $34.15 in interest.
Wow.
200 grand invested.
I'd go out and cry. I mean, that's just awful.
So what about the stock market? The baby boomers are retiring. Most of them are saving the most they've ever saved at the tail end of their career. So they're putting their money away in droves in the last 10 years. What happens the day they quit? They stop putting money in and they start taking money out now to live on. What do you think is going to happen to the stock market is basically based on supply and demand. It's a function of supply and demand. So when people stop buying and start selling, what's that do to demand? Therefore, what do you think it might do with stocks? So this is from a financial planning event that was held here in Tucson. There was a senior VP at Vanguard that came and spoke about the stock market. And this was a bunch of financial planners in the room. So he said, basically educate your clients to expect lower returns going forward. And if you are invested in US investments, expect 4 to 5% return or 4 to 6% in global funds. Well, this makes my notes look really, really good.
Yeah. That's just sad that they would say that about their own forecast, because
Sure.
they've always said, we have between 8 and 12%, which is dubious.
Right. So basically, he says there's 4 options and they're not going to like any of them. Earn more, spend less, work longer, or die younger. And it's just like, wow, that's not very good options. So
Not an option.
what about the 5th option? How about just getting way better returns and mailbox money without the fluctuations with notes? So Nancy, I want to point out something. During the Great Recession, 6 million people were foreclosed on in the United States. 6 million. So that sounds like a big number. But first of all, I want to point out there's 130 million households in the United States. So out of 130 million households, 6 million were foreclosed on. That's less than 5% during the worst 7 years since the Great Depression. So one thing you'll notice on my example I shared earlier, I had a $15,000 down payment on a home that the 30-day MLS middle median value would have been $100,000. That is a 15% down payment based on the median value. Take a wild guess during the recession, out of those 6 million people, what percent of those people had put 15% down?
Oh, gosh.
Or more.
So many people just didn't have cash money,
Right, they were giving loans to people that could fog a mirror and lied about their income and did all kinds of stuff.
Yeah.
Bottom line is, if the loans that failed during the Great Recession, those that had put 15% or more down, less than 1% of them failed in 7 years, less than 1%. So that is a very crucial number, and you want skin in the game. And yes, do you have to work harder to find the buyers that have that much money down? Yes, you do. Are there plenty of buyers with 2,000, 3,000 down? Yes, there are, and they're not going to buy a home from me because they don't have enough skin in the game. That's what keeps them paying, that skin in the game. And every $1,000 that you can get from them as a down payment is going to lower their monthly payment by $7. So if you can get an extra $10,000 from someone, that means that their payment just went down by $70. Now it's harder for them to move because they can't find a home to rent that is less money than what their payment is. And basically, when they get short on money, if the house across the street costs $200 more to rent than this one does to buy, they're going to find someone else not to pay. So,
very good point.
Thank you. So this is the actual elliemay.com website. There's it's an origination insight report is what you're looking for. You can get this emailed to you every month. So this is from February 2018. You can see that over the last several months, it's been fluctuating 70, 71%. That's the closing rate over the last 90 days that people applied for a loan. So of all the loans applied for, 30% are being turned down. I mean, that's just crazy. Tremendous, tremendous opportunity. So in Tucson, these are the number of homes that were sold, and this is the number of people that did a seller carryback. So 4 people in a city of 1 million people, only 4 people did a carryback. So let's see, 30% of the people are being turned down by the bank. 4 people are getting a loan. You see an opportunity there.
Yeah.
So buyers who can't get a loan will pay a premium, just like you pay a premium to be in the east side in Arizona and versus the west facing lot, or be on a hilltop or a golf course. So basically there's 2 rules of real estate. Buyers want houses and sellers want buyers. Well, when you have buyers that are predisposed to pay the highest price, you can get all of the sellers. In a low supply market, having buyers that want to pay a higher price is gold, liquid gold. So notes give home buyers a house that they can call their own, which is the great American dream, an income tax refund, equity and appreciation, and if you're structuring the deals like I like to structure them, a payment less than rent. So for sellers, basically they're getting a faster sale for a higher price with the least amount of hassle. So it's a very, very easy sale to make. Hey, how would you like to just go to bed tonight and be done and make more money than if you got a full price offer? Never have to make your bed again. So now this is how a normal sale works. You have a buyer, a seller, and a bank. So the bank basically gives the buyer a loan to buy the home. The buyer then pays the seller for the property, and then the seller turns around and puts their money back in the bank. But if you don't have a bank, if the buyer can't qualify, then you don't have a sale. Unless you make one little change. What if we replace the bank with a retiree? And you notice I didn't say investor, because investors are greedy pigs. They want too much.
I love that.
So the retiree now is offering financing for the seller. The seller offers the financing to the buyer makes the payments to the retiree. So basically, the seller is financing their home, but they're selling the note to the retiree. Can you sell a note once it's originated? Yep. How many originated notes is the seller going to have in a year? Probably just one.
Yeah, right.
So notes are everywhere. There's tons of places online that you can, go out and do notes. And find them and buy them from other people. And this is just, I Googled, note purchasing or note website, and this is some of the stuff that came up. But, this is a time with 10,000 people retiring every day and banks paying 0.2% interest. This is a perfect time to be out there trying to buy and sell notes. But here's the question. If you had 10 notes and you were going to sell 5 of them, which 5 would you sell? Your 5 best or your 5 worst? And most people know it's, well, yeah, this one's late, this one's a bad collateral, this one's got, and then if you notice this guy counting his money, I got a whole series of dead bodies, and that's the people that bought all the junk from him. So the second question is, why would you buy notes that were set on other people's terms if you can create them with your own terms? And you make the rules, and you make the collateral, and you decide what buyers qualify and which ones don't, and you set the down payment. I mean, it's just way better to set the criteria yourself. So let's go back to the 2 rules of real estate. Buyers want houses and sellers want buyers. Well, in this market, back in 2009, you couldn't hardly give a house away. And now there's a shortage of houses. So the market switched from back in 2009, if you had a buyer, that was gold. Well, now if you have a house, that's the gold. So it switches, and you just got to keep dusting off your playbook as the market changes and switch from being buyer-oriented or seller-oriented. So there's tons of notes that are under your nose, and those that have the houses are going to get the deals. So think about it. Guys that flip houses have the most desirable homes on the MLS. These are homes that are totally renovated, granite counters, brand new cabinets, new flooring, new appliances, new electric panels, air conditioners. But these guys are getting slaughtered by FHA buyers. So most flippers are giving away at least half, if not more, of their profit to real estate commission, to closing costs, to buyer closing costs, and to big, long repair lists.
Wow.
So it's really hard in the first place to find a profitable flip project, because there's a shortage of inventory. So the properties actually went up quite a bit in value, and the profits are less. So they have to do more homes to make the same profit. And then you're giving away half your profit on the resale of the property. So let's look at a flipper's profit. If you bought a $85,000 wholesale property, 65 cents on the dollar, spent 15 grand repairing it, 100,000 total wholesale, you sell it at 130. So, everybody looks at that and says, wow, I made 30 grand, great news. Well, then reality sets in, and you look at your $30,000 gross profit, 7,800 of it was a commission. You got seller closing costs, buyer closing costs, inspection repairs. So just the resale costs of that deal are over half of the $30,000 profit. And, we haven't even talked about the carrying costs of the hard money and other
Right.
things that go into it. So, I mean, it's really difficult for people to make a profit. And now there's a lot of wholesalers who have entered the scene, and the wholesalers are actually taking all the profit away, and they're making more money than the flippers are, by selling the houses with very, very little skin on the bone. So basically, if you're buying from a wholesaler, it's great if you don't have to resell it. If you're going to live in the home, it's an awesome deal. But if you're going to try to resell it, you're going to lose half of the profit on the resale. So now let's look at the lender. The lender on the fix and flip loan made good interest, but then the houses sell immediately, so their money's paid back, and now they're constantly looking to get their money working again and keep. And I showed you that chart. I mean, what happens if it's not working just 10% of the time? It can cost you hundreds of thousands of dollars. So how do you stop, having to work so hard looking for loan opportunities, and also, don't lose every time during the gap between investments? So this is a solution that we came up with a flipper that we funded more than 60 times in Dallas, and I've got a couple of guys here in Tucson that have funded almost that many times as well. So this is a way that the lenders can keep their money working, and flippers can keep they make a lot more, like 3 times more in every house they touch. So if anybody's flipping houses, you definitely want to pay attention to this. So you're going to eliminate any kind of lost revenue from undeployed funds, and the fix and flip contractor is offering these terms. So basically interest-only payments. You can't do that with Dodd-Frank, but if you lend directly to the flipper, there is no Dodd-Frank, because that guy is an investor, not a individual homeowner. So what we're actually doing is flip loans for a 3-year period. We have a 3-year balloon at the end. We pay 2 points at the beginning, 1 point at the end as a going away present, and then a 30% return over the 3-year period. So how does that look? Let's, first of all, the borrower is an investor, so there's no Dodd-Frank. The value doesn't depreciate because it's interest only. A lot of retirees like that their equity isn't being paid down, the principal isn't diminishing. And then a 3-year period of time is a very short period of time. It's great to keep your money working continuously for 3 years, but if the market changes, you're only in for 3 years. You can get back out. Now, if you were lending to a homeowner, Dodd-Frank says the minimum balloon that you can do is 5 years, and you can only do that if you only make 1 loan a year. So this eliminates everything about Dodd-Frank, because we're not lending to consumers, we're lending to an investor, a flipper. And then so the money is delivered by a professional servicing company, and the return is more than twice what the Wall Street professionals say to expect out of the stock market. So let's see, $100,000. If you lend $100,000, it's 2 points up front. So that means you only really have to bring in 98. You're going to get a payment of $733 a month, which is $8,800 a year for 3 years. That's $26,400 over the 3-year period, minus the 2 points that you were saved up front. They still owe you 100, even though you only funded 98. And at the end, you get paid back an extra point. So you put in 98, you get $733 a month, and then you get back 101. And I'll tell you, the retirees are just, I funded a couple weeks ago, we got a package of 6 properties on a Friday. We had them all funded by Sunday. I mean, in 2 days, funded 6 properties with the same marketing plan. So basically, if you invested $98,000 and you made a profit of $29,400, that's a 30% yield over a 3-year period of time, which is a 10% per year yield. Compare that again to Wells Fargo or one of the major banks that pays 0.2, and basically it takes 5 years to make 1%. It would take you 50 years to make this much money at the bank. So when I speak with potential lenders, retirees, then they don't think of themselves as investors, because they're just mom and pop with money in the bank. And basically I say, just think about that. If you go to the grocery store, the next time you're unloading the groceries out of the car, just remember that for every 1 bag of groceries that you're getting out right now, you could have had 50 bags of groceries. If you're earning 0.2 at the bank, this would pay you 50 times more.
Great analogy.
So again, you invest 98, you get paid $26,400 in $733 a month payments. At the end, you get 101. That's a $29,400 profit. So this is a little calculator I built into my note carry software that you can plug in just these white spaces. So basically the address of the property, the interest rate, the loan amount, how many points up front, how many payments in the middle, and how many at the end. So I can calculate these numbers in literally 30 seconds and have the numbers on every new deal. So each time I come up with a different way of funding properties, I build a new calculator in note carry, and we've got probably a couple dozen different ways to calculate things. So what's the insurance? This is from the flipper point of view. So if you flip properties and you're watching this, Now all of a sudden, instead of selling that property for 130, what if I sold it for 140? The buyer gives me $14,000 down. That leaves a $126,000 loan. If you recall, the people who funded nearly all of the acquisition and disposition, except for the 2,000 I gave them in points, they funded 100, but only paid 98. Well, I just got $14,000 for a down payment. That's about what my profit would have been if I turned around and sold that note or sold that property as a flip, right?
Mm-hmm.
Well, now look at how much is owed to me. I owe that person 100, but I'm owed 126. So I got $26,000 worth of equity. I'm getting a payment of $1,215 a month on that loan that I gave, and I'm only paying the interest-only loan $733 a month. So I've got monthly cash flow as a flipper. I still got almost all my money out that I would have got if I sold it, but I'm making the spread, the arbitrage between what I'm being paid and what I have to pay. It's $482 a month. So if I multiply that times 50 deals by doing one a week, by the end of this year, I would have $24,000 of positive cash flow a month in the loan arbitrage. Not to mention that when that loan is paid off, I got the $14,000 up front. I made $17,300 more on the payment spread in the middle, and now the equity that they still owe me over and above what I owe is $19,000 at the end. So now that little $100,000 flip home that I bought for 85 grand just gave me a $50,000 profit.
Wow. That's
so
amazing.
On a traditional model, if you remember, my profit was going to be $14,440. So I just made $36,000 more on every single home that I touch. That's a pretty amazing flip model.
Yeah, it is. I love the additional wrap that you put in there. So those have worked well for me in the past, but I like what you're doing with that.
Thank you. So who wins? Basically, the lenders are getting consistent mailbox money instead of having to go find new notes every 3 months. Flippers are making 3 times more on every project. Buyers get the American dream of home ownership. Sellers are getting a higher, faster, easier sale. And the neighbors are getting a new high comp. I cannot tell you how many times I get called by appraisers wanting to know, why did that house sell for so high? I'm looking at all the comps and you have the highest priced homes in that neighborhood. Now, this is something I haven't even been doing, but I really should start. I should be sending a postcard out to every other homeowner in that neighborhood, congratulating them on the new high price I just got for them.
Well, it's true. You've done them a huge favor because you just raised the price, raised the value, because otherwise what else is pushing up that market value?
Right. Appraisers, if you left it to appraisers, there would never be market appreciation, because just by the very definition, they have to show the bank 3 other people in the rearview mirror who over past time have paid this much money for a home. They will never allow you to be the new trendsetter and set a new high price. So you can change your outcome if you're tired of all the big banks making all the money. Boot the bank and keep that money for yourself by being a private lender. So I'm going to show you why I like the Dallas-Fort Worth area, and then I'll wrap it up and we can answer any of the questions you have, Nancy. Okay. So Dallas-Fort Worth, it's the fastest growing real estate market in the United States. Real estate values are a function of supply and demand. So this is the first thing. If you're looking at buying a note in the Rust Belt, in different markets in Ohio and Michigan, in Pennsylvania, the first thing you should do is go to Wikipedia and look at the census numbers from 2000 and look at them again from 2010 and find out, is that population shrinking or growing? A lot of the places are losing people. So if a whole bunch of people leave, what's the value of the home? There's the same number of homes. A couple a year might burn down or something, but basically there's more homes than there are people. What do you think the values are going to do?
Right.
So Dallas-Fort Worth has 3 of the top populated, the 50 most populated cities in the United States. They have Dallas, Fort Worth, and Arlington, all of which are a combined population of 7.5 million people. It's actually 7.9 now, and these numbers are 2018. They're projected in 2020 to be 9.2 million. So they're going to gain 1.5 million people over the next 3 years. So of the top 100 fastest growing counties in the United States, 9 of them are in Dallas-Fort Worth. That's amazing. So last year, 393 people a day moved into the Dallas-Fort Worth area, and the home builders are not keeping up. So again, what does that do to the value? So this is an example. This is a little note we funded in Mesquite, Texas. We've been pretty much, we met with this flipper over Christmas, and he said, I want to do one a week this year. And we thought, okay, well, we did 17 in the last 2 months. So he's way, way, way ahead of schedule. So this little neighborhood is, that green stuff is grass, and those things are trees for those Arizonans like us.
Yeah, right.
Nice residential neighborhood, close to shopping, close to a bunch of stuff. There's a nice green belt walking area around the neighborhood. So Realtor.com says the value is 122. Redfin says 120. I mean, you can go out and look at all the automatic valuation generators and come up with all kinds of stuff. But this is the little house, right here. So basically, I look around and I say, is it out of line for me to sell my house for $130,000 or $140,000? And look at how many other homes in the neighborhood have sold in the 130s. And so it's, for me to charge 140, it is not out of line if I'm carrying the paper. So now the biggest question people have is, who comes first? Is it the buyer? Is it the seller? Is it an investor, that puts funds the deal? And the answer pretty much is going to be the deal. Money never comes first. Money always comes last. They want to know who they're lending to. They want to know what the collateral is. They want to know, all the aspects. The story is the most important part. This guy works at such and such. They can't get a loan because, that's the most important part about raising money. So this deal is required for the money to go to work. The money is required for the deal to close. So it takes both of them to happen, but the deal typically comes first. It doesn't matter if you have a buyer or a seller first, but the deal has to come first. So we have a deal plus money is where the profit comes from. So if you have a deal but no money, that deal can't close, and therefore your profit is going to take a tumble because you put up money for earnest money and you couldn't close the deal and the profit evaporates. Many of us have had that happen. What if you got no money? A deal and no money doesn't do you any good either, because you got to be able to close. So basically you need both. And one last thing before we go, anybody that's interested, once a year, I've been doing this for 10 years, I have a 3-day conference in Tucson, Arizona. This is everything I know about notes, about real estate, anything I'm doing myself. I put this on, it's a full-blown conference. I have national speakers that fly in to help me. And every single year I've taken 100% of the proceeds and donated it to Make-A-Wish Foundation. So if you have any way, shape, or form to get here, you want to go to notebusinessbuilder.com. We were able last year at our conference to grant the wish of this little girl, and actually 11 wishes at our conference. We got to send her to go see the Macy's Thanksgiving Day Parade. So it was an amazing opportunity. And this was the proceeds that we delivered from the conference last year. So, and that conference has actually enabled me to be the sponsor of the Walk for Wishes here in Tucson. And our little company, our note buying business, we represent almost 20% of everything Make-A-Wish raises in Southern Arizona. So it's a pretty cool thing to do.
Wow, that's awesome. Well, I'm definitely going to be there. Have to go buy my ticket for that. Actually, tickets, I'll probably bring my husband. I think anybody that's interested in notes, it's certainly in Arizona or California or, within driving distance ought to get there, if not further.
And I should have put up the slide, and actually I have a website for the event. It's called notebusinessbuilder.com. So just up at the top of this, I just put a .com at the end with no spaces, and that's the registration website.
Okay.
And the cost of the course, if you wait till the end, in October to sign up, it's going to be $795. Right now, you can get in for $495. And every month, starting in July, every month the price is going to increase by $100. So, and again, your check is made out directly to the Make-A-Wish Foundation.
Oh, that's awesome. That's terrific.
Thank you. So what kind of questions do you have, Nancy?
Well,
I about 80 pages of content here.
Yeah, I mean, you just blasted through a whole bunch of ideas. Even if somebody didn't take what you have and did it exactly that way, you could still model it differently. For instance, and I'll start with the way that you structure notes on a house that you're helping somebody to buy, basically. I've got, we still hold some rentals. Some of them I've moved as into notes, but I did not do the 70 or 75 to 25, first and second split, which I will the next
Right.
one.
What makes that
Because,
75 very easy to sell? And
yeah,
then if you have a profit built into the second, you can actually get most of your money back out of the first and go do it again and again and again. Just keep recycling the same money.
I love that idea. Just to put some of that together and sell off the first, and then I could go buy another condo or whatever and sell that, and then go do it again and rinse and repeat as often as I want. But
Right.
I also like your idea of working with flippers as well, because certainly there's quite a few of those in Phoenix. The price point's getting up there.
Right.
Things are moving up, and and I like the way that you found places in Dallas, for instance, that'll work. And one of the questions I had for you is when you're doing a deal with a flipper, and you were talking about wrapping the loan, what is it that the retiree is, I was going to say investor, but the retiree is buying? Are they buying a first trust deed?
Yeah, it's a first position note to the
Okay.
investor. That note is being wrapped with the second that he's giving to the home buyer.
Okay.
And literally, I mean, there's so much money out there. Hedge fund money is really coming after notes. If you've got a seasoned first position note for 3 years, do you think there might be some buyers 3 years from now?
Oh yeah, heck
With a
yeah.
note that's paying 10% yield base rate, I mean, you can sell that note at par. You would have a line out the door selling that note at par. But because he's got 19,000 built into it, excess equity, I mean, he has room to even discount it if he needed to. So I'm not worried at all about the exit strategy. As a matter of fact, I actually think that most of those people, when they see the end coming on the end of their $733 payments, they're not going to want to go back to Wells Fargo to get 16 bucks, and they're going to say, hey, can I re-up for another 3 years? And basically you sell them the front end, the next 3 years of the note, same terms.
Well, the other thing that you really, I think, illustrate for somebody that likes to look at spreadsheets, and I actually do, we like to put calculators together and everything, as much as the power of compound interest is a benefit to people, it can also kick your butt if you don't have that money working. And your illustration put that together beautifully. It is a double-edged sword if you don't put your money to work. So I think that the idea that a note investor or someone who's originating notes would be able to share that with potential investors or retirees would really bring that point home. You're not doing the dance of the seven fans to tell them, oh, please buy my note. You're just giving them the facts.
Right.
And so,
yeah, I'm going to show you something, a little calculator I have here. So I have this little tool called a missing value calculator. And it's not rocket science, but if I took that $30,000 second we were talking about, and then it was an 8% interest rate for 360 months. First of all, like any financial calculator, I can calculate the payment, 220.13. So then I say, what if I was going to sell 60 of those payments, the front end of that note, and I'm going to offer 8%? How much would they pay me for that note? And they're going to pay me $10,856. Well, what if they don't bite on 8%? What if I want to give them 9%? Because what I'm selling is the payment stream. I'm selling that amount because that's what the buyer's making. I can charge whatever I want. Well, now it's $10,604. What if they want 10? So now it's 10,360. So, I mean, it doesn't cost me very much at all. But look what I just did. I mean, here's a note I bought for 5,000. I sell off 5 payments and I make over 10,000. So I just doubled my money. And guess what happens? When that note comes back to me, there's going to be 300 payments left because 60 have been delivered to someone else, right?
mm-hmm.
So now if I go back to the 8% rate that I was earning at, that's the balance still left on my note. So it cost me $1,479 to sell that note and make $10,000 right now, double my money upfront. It comes back. How many times can I sell off 5 years on a 30-year note? I can do it 6 times.
Yeah, and actually I mean, I've looked at calculations that show what that looks like, and you really do very well on that by selling each of those 5-year increments.
Yeah, and especially, you know, if you're buying at a discount. So that's, you know, one of the biggest complaints, and this is, you know, I had this discussion with John Schaub at the Paper Source, and I said, hey, John, you know, what percentage of your investments are in real estate? And he goes, well, you know, because the market is appreciating at over 10% a year, over the last several years, I've really amped up my real estate holding portion because I'm leveraged on that, and I'm making 10% on, you know, maybe 20% down payment. So I'm really, you know, making a good profit. But when the real estate appreciation slows down, I'm going to go back to my notes, which are paying a 10% return. Well, if you can buy a note, you know, as I illustrated, what if I could buy that note, 360-month note that has a value of 30,000? If I can buy it for 5, that's where I calculate my 52.8% yield. There's not too many real estate investments that make 52.8%. And then, you know, I have this little calculator I built called note versus rent. So if I did 123 Main Street, and I'll show you just how fast this tool is to use. Let's say the house is worth 100,000, same as our example. We can sell it for 115, or I'm sorry, it's a premium of 15,000 and a down payment of 15,000. Let's say that the rent right now is $975. There's a 5% vacancy. The note is going to earn 7.75 blended rate, 360-month term. I'm going to earn 10% on the buyer's down payment because I can reinvest that in other notes. So my property management fee is 10%. The taxes are $1,200. Insurance $600. Let's say there's no homeowners on this one. I don't pay any utilities, and I pay $75 a month in maintenance. I'm in a 28% tax bracket. I'm going to hold it 5 years before I sell it otherwise, and it might appreciate 3% a year. So now I can look at note versus rent. So if I'm holding this as a rental, my property is worth 100. I got a security deposit, but when those people leave, I either have to give that deposit back or spend it on the stuff that they broke. So if I'm the, isn't that true? But if I sold it, first of all, I can sell it at a much higher price, get a $15,000 down. Now my basis went to 85 because I already got 15,000 cash out of it. So now the rent is 975 less the 5% in vacancy. That gives you adjusted gross income of 926. Look, my note only pays 716. So your rental is better, right? No, because your rental comes with all these things called expenses. So basically, when you get paid, there's all these other hands out wanting to get paid too. $323 of your 926 adjusted gross is going to other people, which means you're only getting $604 and I'm getting 716 on my note. So you're going to say, but wait a minute, I get to write this off on my taxes. So I get depreciation of $68 and an income tax refund on these expenses up here of $90. So I'm going to get back $158. Well, if I add those two together, now I am getting 762 and you're getting 716. So if you're getting more than me, why is my yield greater than yours? And the answer is because you're still based on a $100,000 basis and I'm at an $85,000 basis. So I should be making less money because I don't have as much invested. But now let's look after 5 years. During those next 5 years, you will have made $36,225 in rent. My note paid $42,985. You got back $9,491 in income tax refund, but now that you're selling, you got to recapture that depreciation that you took. I didn't have any of those benefits or that loss, but you are hoping for a $15,927 appreciation. My appreciation came the first day when I got a check for $15,000. And also I invested that money at 10%. Over the next 5 years, I'm going to make $7,500 on the invested cash that they gave me as a down payment. Now, just to be fair, my note included principal. So if I back out the principal that's no longer due to me, I made $61,105. You made $57,570. I made 14.3. You made 11.5. But the biggest thing is you got all the phone calls. I got all the money.
That's it. And that's the only, and I love this calculator because I'm looking at doing these things myself, and we haven't sold some of our stuff because the appreciation's been so good. But
Right.
now I'm starting to put together the numbers and go, but this is a much more succinct way of doing that. And the other thing that isn't calculated, it's really hard to measure, is the phone calls.
Right.
Showing the place, or if you have a management company, well, they're going to do it, but we self-manage ours. So, because I don't have that many, but still, somebody calls with the toilet overflowing, or they're going to move out, or the AC doesn't work. God forbid the AC doesn't work
Right.
in
weather.
Yeah, I mean, it's a bona fide emergency here in Arizona. You got to go help them out. So, yeah.
So anyway, this is a
brilliant.
very, very simple little thing, but if you're going to go talk to a landlord, this is what you want to show them. And it's a why. It's why would I do that? And it's like you, and especially I just love finding landlords on Craigslist or Facebook Marketplace that have their property for rented for rent right now. So the first question is, if it's for rent right now, how much income are they earning this month on that property?
Exactly.
Nothing. Okay, what just happened? Do you think the last tenant left the property in pristine condition, move-in ready? No. These people just probably spent the last couple of weeks, if not a month of their life, going over there cleaning other people's dirt. So really, that's what you are. You're a maid. You're a maid in a hotel that you own, and you're stuck cleaning everybody's dirt whenever they leave. And that's basically what being a landlord isn't an investment; it's a job. Being a flipper isn't an investment, it's a job. Being a real estate agent isn't an investment, it's a job. Being a note holder is an investment.
Well, I love it. I love it. Now, before we let you go, tell me about how would somebody tap into the calculators that you have here? You have like a membership?
Yeah, I do. I started with the software. And by the way, I never even built this to sell. I built it for me. I had 22 real estate agents working in my real estate brokerage, and they all wanted access to it. And I'd spent so much time developing all these tools, I didn't want to just give them my Excel sheet, and then when they leave the company, they take all my intellectual property with them. So I went out and I hired a programmer to put it into PHP code and put it on the web. And then I showed this at my charity conference back in 2013. And I mean, the hands just went up like, how do I get that? And it's like, well, you can't, it's mine, So I went and invested $10,000 building out the site, so that other people could benefit from it. And at the time, they asked how much it was, and I said, I don't know, $10 a month. I literally still have people paying me $10 a month, even though I've added a tremendous amount of content to it. So if you want the software only, there's actually, you can just go out to notecarry.com. And actually right now we're in the process of merging everything. I later found that people weren't staying. They would buy it for a year and then quit. And I talked to them and they go, yeah, I just never really knew how to use it. So I started my mentoring business with 5 videos. I was just going to show them how I use it. And those 5 videos have turned into 4 years of weekly webinars. I have almost 160 recorded webinars on the web, on the site. The last 4 years of 3-day conference are all recorded. I've got all the calculators, everything. And basically, if someone wants to buy this by the year, it's just under $3,000. It's $2,998. And if you renew it, basically the renewal for the people that have paid for the first year is $19.98 a year. And that's all the webinars, that's the mentoring. Basically I help you structure deals. If you have deals, I don't call you up and say, go out and put up signs, or, I'm not, and basically I can't motivate you if you can't motivate yourself. But, I love helping people structure deals. And I currently have people in 28 states that are on the calls on the weeks. And over half of my my people in my no carry group are not real estate agents. They don't have a real estate license. They're actually investors. And I have several that are in their 70s and they're worth millions of dollars. And they come here to get notes because this is a place they like the people that are structuring the deals the way that I teach them to structure them. And they like to fund those kinds of deals because they understand them and they know that there's skin in the game. And that, you know, our main focus is building a win-win-win deal for everybody. The only people that lose on my deals are the banks that turn down the buyer in the first place.
Well, this is awesome. I really appreciate you taking the time to show this off. I think for somebody who, and I know I've met a lot of people that are wanting to learn the note business, and there's various ways of doing that and some content out there, but your ideas are just awesome. So I think somebody would do really well with this.
I appreciate that, Nancy.
So, okay. Well, I guess we could wrap this up. Thank you so much for taking the time. And I will post this up. And of course, you'll have a copy of it too. So
awesome. All right. Thanks, Nancy. I appreciate you having me on.
Thanks. All right. We'll talk to you later.
All right. Bye.